One of the most powerful tax planning tools available is the Roth conversion. But to use this to its full potential, you need to have time on your side, the right financial situation, and an understanding of when it's appropriate to convert. Getting this wrong can feel like an absolute punch to the gut and have permanent consequences. In this video, I'm going to cover 3 of the biggest and costliest mistakes that I've seen people make, so you know what to avoid if you're thinking about this for yourself. But first, I'm Crossland of Suttle Crossland Wealth Advisors. I help folks build more tax-efficient retirements, so let's get into it. If you don't know what a Roth conversion is or unsure, here's a quick refresh. Roth conversions involve moving money or investments from traditional retirement accounts like an IRA or 401k into a Roth IRA. The action of doing this converts it from pre-tax to after-tax, and as such requires you to then recognize the amount of value converted as income for the year. Here's a quick example. Imagine you had an old IRA with $10,000 of pre-tax value and converted it to a Roth IRA. That $10,000 would then count as income to you for the year. You then have to pay income tax in relation to the rest of your situation. Hopefully that's enough of a quick refresh, but if you end up having other questions, let me know down in the comments. Now, while some of you may only convert once ever, for others, a plan to convert to Roth may be run over the course of years. And a lot can change year to year depending on things like legislative changes, changes to income, or impacts from other items that might affect adjusted gross income. This means that this can end up a going concern and would require year-over-year analysis to make sure you're avoiding mistakes. And while there can certainly be more than just 3 mistakes that folks will make when converting to a Roth IRA, let's now cover what I see as 3 of the biggest. The first mistake that I see is not knowing that under the current Tax Cuts and Jobs Act, conversions to Roth IRAs are permanent. More precisely, they repealed the special rule of recharacterizing a Roth conversion. And with the ability for a lot of brokerage platforms to allow you to convert all by your lonesome without a call-in, fat fingering your conversion and adding one too many zeros on the end cannot be fixed. This can end up making the timing of Roth conversions problematic as well. There are strategies where some folks will try to convert at the very beginning of the year. That way they can have the entire market year to see growth in that account. And then there are folks that may convert throughout the year, but in any event, there's always a chance that by the end of the year, you can end up with income surprises or other distributions that you may not have been expecting, and then that can mess everything up. You simply can't go back and adjust some or all of a Roth conversion based on how your year unfolds. This ends up putting a much bigger planning responsibility on you before you actually end up taking any action. I can't tell you the number of stories I've heard from other advisors or just other clients about doing conversions and not being aware that they could not go back and fix it. Now, if the Tax Cuts and Jobs Act ends up sunsetting at the end of 2025, this may no longer be a concern. But until then, or if Congress decides to extend the Tax Cuts and Jobs Act or decides to maintain this particular feature of it, a lot of care is going to be needed to ensure you are not making mistakes. The second big mistake that I see folks make, and this one can be costly, is not paying attention to all of the tax impacts of the conversion. Since conversions require you to recognize any pre-tax money as income for the year, you can very easily misjudge moving into higher tax brackets or moving past certain thresholds or even trigger undesired surtaxes. And the secondary concern about perhaps accidentally pushing your conversion into an even higher marginal bracket is you have now essentially locked that money in at that tax rate forever. As I mentioned as well, going over certain thresholds can also trigger things like net investment income tax, and I did a video on this. I'll put a link to that in the description if you want to check that out. But it can also affect other things as well, like if you are old enough and at Medicare age, you might accidentally push your adjusted gross income past a threshold where you now have to pay a higher Medicare premium. And one of the worst surprises that can kind of go along with this is putting yourself in a position where you might miss out on very valuable credits. Imagine losing out on things like Affordable Care Act credits, credits related to dependent care, or even child tax credits. All of these act as in essence an additional tax cost, and that will lead to tax drag on your portfolio. And the more expensive it gets from a tax perspective on you converting, the less valuable that conversion can end up becoming. And something else I'll see from time to time as well is folks converting and then just not being ready for the tax bill that comes comes later. Most strategies in conversion don't have you doing withholding as a part of the conversion. There could be niche cases where that might make some sense, but if you're not doing withholding, this means that the income from the tax liability still needs to be handled. This also means that income earned needs to have the proper tax paid in a timely manner as well. If you don't know what that means or you're confused by it, consult a tax advisor. Remember, the whole point of doing a Roth conversion is to create a tax advantage for yourself, but how much you pay in tax to do that really matters. And the third biggest mistake that I see too often is starting late. Waiting until you have more regular income sources or a higher income situation in retirement might mean it's too late to avoid excess costs and other tax drags. Waiting until you are at or in required minimum distribution years might make for a bad decision. So if you end up having low income years and you don't use them, you may not get a direct benefit by doing a Roth conversion. You could still always assess the merits of it based on maybe a legacy or estate planning goal, but you may not care at that point. And converting for the sake of an estate plan or legacy just may not be that high on your list of priorities. Don't fail to use early retirement years or low income years if you have them. At the very least, this should be assessed for its merits year over year. Now, these are just my opinion on what I think are 3 of the biggest and costliest mistakes that I think people can make with Roth conversion. Let me know what mistakes you've run into, or let me know if there are mistakes that you feel are bigger or of more importance than what I've included in this list. Once more, I'm Curtis Crossland, and if you want to see how we help folks build a more tax-focused and efficient retirement, be sure to check us out at SuttleCrossland.com and subscribe for future videos.